Our market master is ready with us. Andrew Holland is Chief Executive Officer at Avendus Capital Public Markets, Alternate Strategies, LLP. Andrew, great to have you with us here on the program as always. Thanks very much. So, easy question to you. What's the, you're already laughing. What's the first reaction, what's the reaction to of the market's going to be tomorrow morning? Up or down, and by how much?
Yeah, I'm just thinking about your PTM conversation. There's never an easy question for you, Prashant. But anyways, let me try and deal with that one. Listen, I think the market's trying to talk itself into a kind of a relief rally, isn't it? It's saying 75 bips is great, 100 is even better. And then the Fed will be, kind of around or ahead of the curve. That's what the market's hoping for. So I think, the higher the rate increase, the more kind of expectation that the Fed will then, I'm not saying going on pause, but might kind of indicate in its statements that they'll see how a higher rate hike kind of plays out in the near term. But Prashant, we're at that level, again, we talked about this many times, is it all priced in? And I would say, yes, it probably is in the very short term. But my fear continues to be that, interest rate hikes and the tightening of the balance sheet or reduction in the balance sheet could have its unintended consequences in certain asset classes. Maybe it's playing out now in crypto. Maybe there's other areas like SPACs or private equity where it's still to play out, and that will lead to a number of things. One is earnings downgrades are going to have to happen in the US and globally, and we're starting to see it here. Now, the good news from all of that is that aggregate demand is falling sharply. You've seen it with the likes of Target. You've seen it with the likes of Intel talking about demand, starting to ebb away. So the consumer in the US, the household balance sheet, whilst everyone says it's been very strong, I'm not sure it is. I mean, they're already using their credit cards more and more on essentials rather than obviously discretionary spending. That's not good news. So the good news, though, for India is that commodity prices, I'm talking about mainly metals here, will start to fall very, very quickly as we move, as the economy globally starts to falter. And I think it's going to be very quick.
But the problem, Andrew, is what happens here, right? I mean, as they say, when the US sneezes, the world catches a cold. And what a cold it's been, especially for retail investors here in India. What is the strategy now? What's the best approach for the rest of the year?
So I think just for the next few months, and I've mentioned this before, you're just sitting on the sidelines, holding some cash, protecting capital. It's not a bad strategy. I think everyone forgets that cash can be a strategy in volatile times. But if we're correct and we're starting to see the global economy really falter, and then the Fed will go and hold towards the back end of the year, this will bring a risk on trade back. And that's where I think foreign investors will come back to India in very significant ways, because we will be seen as the growth area globally. And I think that's what I think I would get excited about. So two things. The way I think about this is, for the next few months, just continue to sit on the sidelines unless something changes drastically more positively, which I don't see. Two is think about the deflation trade, because if the global economy is starting to fall, then that's the time to be. So I think banking sector is something I'd be looking at. Not right now, but I think that's the play I would look for. And finally, in terms of where can markets go from here, if there's any kind of unintended consequences, then I think that the S&P probably has maybe another 10% fall from where it is, and I think ours is a 5% fall. So around that 15,000 Nifty, I think is a good time to be then starting to deploy money again.
All right, sit on the sidelines, 15,000 Nifty, start deploying some money, and it appeared that you're fairly optimistic on some of these financial names, banking names as well. So let's focus on that fact itself. In the financial banking space, what would it be? Would it be just the large private sector banks, or would you look at some of those PSUs, the larger PSU bank as well?
No, I'd particularly go for the private banks. They've been hit quite hard, and I think that's where I would really start picking up my investments. If this plays out, as I said, I think the market's pricing a lot of the bad news at the moment. So you might have that relief rally, but it's what tightening will bring to some of these asset classes, whether it's high yield or other areas, which is just a concern in the next few months.
Just put up Tata Communications, the stock, and it's coming off sharply right now. It's down about 6.5%, 7%. There you go. I mean, 5.5%. So it's coming off with the lows a little bit. It was down 7 nearly, 870. I think there was an analyst meet, which took place, but I don't know, there was something said there.
I think what the street wanted to hear was a revenue growth guidance, but that was missing at the analyst meet, so there was no clarity on that. And I think Sonal also, she did a link earlier where she did talk about how CLSA has cut their target price quite a bit. It's still above the current market price. It's at about 1,070, but they had almost a 1,500 rupee target price earlier. The management is taking multiple initiatives to strengthen its portfolio, but the data revenue growth has been quite muted for them, and the lack of any kind of revenue guidance is like
visibility,
perhaps spooking the street.
Yeah, no, absolutely. The other one is, of course, HDFC, which continues to be under pressure. HDFC is down. I mean, it's having a bad week, isn't it? I mean, the correction started last Friday, the big one. So over last Friday and Monday, it lost 8%. Then there was yesterday, now another 1% today. So generally a bad time for the stock. Canara Bank is down about 2.75%. So now it's picking up. ABFRL is another one which is down about 2.6%. And of course, Reliance itself is under 2,600 now, 2,591 on Reliance Industries. Andrew, any thoughts here on the big one, RIL?
I think I think on the long term it's fine. I think the market's grappling with some of the expenditure it's doing, and obviously there's talk of them in the fray for Boots as well. So all of that will need to be funded from somewhere. So I think the market's just trying to digest if that's going to happen and what that really means. So I think along with the rest of the index, I think it's going to be a laggard in the short term. But I think, again, I think where you need to look is what the themes are going to play out, Prashant, is that deflation trade, which I talked about. And second is the CapEx cycle, which you're going to see in 2023. And I mentioned it before, it's governments and companies looking to fill in that gap of supply chain security. But it's not your normal. You will have your normal bridges, roads, and etc. CapEx, but I think it's going to be those companies which can produce smart offices, smart factories, smart whatever it is. So it's outside of the normal L&Ts and BHLs of this world. It's more your kind of ABB, Siemens, which are going to be the beneficiaries of this big CapEx cycle, which I think is going to happen globally from 2023.
What about the big spending cycle? I mean, you just step out of your home in Mumbai and anywhere you go, it's packed. Hotels are packed, restaurants are packed, theaters, travel, inflation or no inflation, people are out spending. So do you think this is a theme that one should play? And if yes, how?
Yeah, no, the reopening theme is going to play out for a while longer. I mean, we're still seeing it, played out. In developed markets, we're just behind in terms of our reopening. So, hotels, airlines are going to be the two main areas, I would say. But I think, the one area which I would look at is autos again, because I think if correct, and you will start to see the supply chains coming, back online, particularly in terms of semiconductors and in terms of, steel prices falling, then this is going to be a great margin improvement. Not now, but towards the back end of the year. So I think autos is probably a good play on this deflation trade as well, apart from banks.
Okay, and within autos, what would it be? The CV space, or would you look at the PV space? Because two-wheelers, I think sales numbers are still to pick up there.
Yeah, I'd probably go for the for the four-wheelers rather than two-wheelers right now. But I think I think the whole EV space is going to be exciting. So I wouldn't want to miss out on the two-wheeler space at this point. And again, they're going to be beneficiaries from this deflation trade. So I think the whole auto sector, probably including components, but not right now, would be the play.
Okay. Any opportunistic ideas apart from what we've spoken about, Andrew, which you're acting on, you've already acted upon, you'd like to outline?
No, I think Prashant, it's very easy to say this is going to be a relief rally, and the consensus has really got there very quickly. The fact is that everyone's kind of looking towards a higher interest rate hike, but not really kind of working on the basis that the Federal Reserve has got it wrong twice now, and that can't be good news, right? For companies, trying to kind of weed their way through. And I think that the top line for companies is going to be fine. I think the bottom line is going to be ugly, because I think the margin pressure they're seeing at the moment and the inventories they're starting to hold is just going to be a killer for them. So earnings have to be downgraded significantly here in India as well. So that's the other leg. So whilst everyone's saying markets fall and P's are looking more attractive, I don't think anyone's taken a red pen significantly to earnings. Yes, they started off at 24, 25, and I think consensus is more around 15, but I think it's going to be sub 10 by the time we finish.
Andrew, so you spoke about a couple of pockets, right? You said autos, you like some of these, the revival in consumption plays, whether it's airlines, hotels, etc. What else should one be looking at? Because there are spaces which are doing quite badly, whether it's technology names. Some of the global auto stocks are also getting hit quite hard because of the supply side issues there. Any of these pockets that you like?
No, so it'd be quite tempting, right, to look at IT again because of the depreciation of the rupee, and I think it's an area to keep an eye on. But if technology stocks in the US are still going to be under pressure, it's a sentiment factor, and I just don't think you can ride this one through. You can't walk up the down escalator with sentiment so highly against kind of this sector. So it's not something I'd really want to play right now until the Fed stops. That's when I'd probably look again at the IT sector. And I think the other thing, to all of you is that the currency markets, we kind of ignored them, but at some point the Chinese are going to look at their currency as they reopen to try and get exports, to find that they're not very competitive against a lot of other currencies. So I wonder if the Chinese might look at some kind of form of depreciation of their currencies. I'm not saying we're getting into currency wars, but I wouldn't be surprised.
Okay, we'll keep an eye. Thanks very much for laying your views out for us. It's always a pleasure, Andrew. Thank you very much
Thank
for
you.
joining us here on CNBC-TV18.